Welcome to the Ellsworth Advisors monthly update for January 2026. I'm Kelly Keenan. This is Cameron Mealy. Today we'll talk about how things are going so far this year and kind of our expectations moving forward. Cam, why don't you kick us off with some economic data?
Perfect, will do. Morning, everybody. Hope everybody is well out there. For reference, today is Wednesday, February 4th. Kelly, we got a lot to talk about. The end of one government shutdown means that the black hole on data is now gone, so we have a lot of data to talk about. And we could be looking at another government shutdown. So,
fantastic.
Current government shutdown has been avoided thus far, but there is still a DHS funding issue that needs to be taken care of. So we're not out of the woods yet in terms of the government shutdown, but at least for now we are, and we have some information. So let's kick it off with GDP. On January 22nd, the Bureau of Economic Analysis reported that according to its updated estimate, GDP in the third quarter increased at an annualized rate of 4.4%. Now, this compares to a 0.5% decline in the first quarter of 2025, a 3.8% increase in the second quarter, and now 4.4%. So obviously, very strong GDP. And that strength or resiliency of the U.S. economy, diversity of the U.S. economy, whatever you want to say, is underscored in the projections for the fourth quarter. So on February 2nd, the Atlanta Fed's GDP Now forecast model is predicting fourth quarter GDP will increase at an annualized rate of 4.2%. So you put a negative first quarter along with very strong second, third, and fourth quarter, we could be looking at, we could be possibly looking at GDP for 2025 of 3% or above, which is a very strong number. We're kind of used to the U.S. economy growing at about a 2%, kind of an inflation rate GDP number. So GDP certainly seems to be strong right now.
I'd call it good. Kind of what we expected after the tariff stuff. Imports have gone down, which means export, relatively speaking, exports higher. So that definitely helps GDP.
Yep.
But we're still in I call it decent growth economy at this point.
Yep. Obviously, with growth and with still coming out of the back end of COVID and the money that was put out there, we're still talking about inflation. So let's look at the three major gauges of inflation. Producer Price Index on January 30th, the Bureau of Labor Statistics reported that the Producer Price Index increased 0.5% in December. This was slightly higher than analysts expected. On a year-over-year basis, the index is up 3%, which still is higher than we want to see. But this compares favorably to the 3.5% increase in 2024. The Personal Consumption Expenditure Index, again, this is obviously quoted. This is constantly quoted as the Fed's leading gauge of inflation. On January 22nd, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.2% in November. For the 12 months ending November, the index was up 2.8%, still waiting on December's numbers. The Consumer Price Index. On January 13th, the Bureau of Labor Statistics reported that the Consumer Price Index increased 0.3% in December. On a year-over-year basis, the index is up 2.7%, which was the same as November. So we have a strong GDP. We have inflation still running a little bit higher. And really, if we see anything right now that causes concern above maybe a heightened inflation rate, it's still the employment situation.
Right. Yeah. Inflation's sticky, and
I think it
seems like it's going to hang around 3 for a while.
Yeah. If we look at the January jobs, this is unofficial because this is ADP. This is their internal monthly reporting pool that they've started publishing now. Is really people are getting. It's getting more respect in the market, and people are really looking at it that maybe they have a little better handle on the information versus the Bureau of Labor Statistics. On February 4th, ADP reported that the U.S. added 22,000 jobs in January. This was below the consensus estimate of 42,000 jobs. The Bureau of Labor Statistics will publish the official read on January jobs when it distributes its jobs report this Friday, February 4th. And again, consensus estimate was 42,000 jobs. So we'll see how the official number comes out. A couple of things I want to bring out. This is more of a look at 2026. This is from Goldman Sachs. Goldman Sachs says that U.S. GDP is forecasted to expand 2.5%. versus the consensus estimate of 2.1% in 2025. Goldman Sachs says that core personal consumption expenditure inflation is estimated to fall to 2.1% by December of 2026 on a year-over-year basis. Key drivers for the forecast for solid GDP growth is that the drag from tariffs should give way to a boost from personal and business tax cuts. And then lastly, given that the expectation of Goldman Sachs to see inflation moderating, they expect the Fed to cut 2 times, 25 basis points. Obviously, we have a new Fed chairman has been announced by the Trump administration. Still need to go through the process, but Trump's got his guy. He's a hawk. We're expecting some rate cuts. I'm not sure the Fed can be overly aggressive in terms of cutting rates in 2026. I think they should stand pat. But again, you've got a commander-in-chief that really wants to see lower rates. He's put his person in that position. And so we'll probably see some rate cuts in 2026. But I expect, we should see good growth in 2026, probably sluggish job performance. But it seems like we're kind of in this economy where whether it's productivity, AI, whatever it might be, physical jobs are not really here right now.
We have decent growth. We have a little bit of inflation. I don't necessarily agree with Goldman on the 2.1. I think we stick around 3-ish, about where we're at, where we have been. So kind of an inflationary growth environment, not necessarily a bad thing. I would say we're positioned well for that inside the portfolios. On the Kevin Warsh, the announced to be new
Fed chairman.
Chairman. He's a pretty rational guy. Everything I've read and his history, he would fairly pragmatic. Yeah, we could use at least 1 or 2 cuts just to kind of get the Fed funds in line with the longer term rates. I don't think that's anything crazy. Is he going to slash and burn where Trump would want him to take rates to 1 or 0? Mm-hmm. Not going to happen. So
you think if GDP is showing growth at above 3% and inflation sticking around, you still think that we should see some rate cuts in 2026?
Just to kind of normalize the yield curve. I mean, you get the Fed funds right around 3 to 3.25.
So you don't want to bring the short down?
Yeah, if you have 3% inflation, short-term money,
call it 3%.
You're covering inflation. There you go. I mean, that's kind of how the numbers work out, and it's rational. The rest of the yield curve is fairly rational too. So it's just this short end that needs to be adjusted, and I don't think that's not going to move the needle economically to any major extent, and it's not flooding the market with cash. Warsh could introduce some different things with the Fed balance sheet, but if anything, we're in a bit of a tightening mode. If anything, with monetary conditions, whether it's balance sheet or interest rates, not so much. Big picture, there are some good tailwinds, tax cuts, regulatory issues, tariffs kind of falling by the way. Corporate America has definitely dealt with it pretty well. And the big challenge in the market now is what's going on in the tech world, AI, the big tech companies. I think the realization that pricing may have gotten a little bit ahead of itself. This is typical, and it's kind of happening now. We haven't seen those stocks have definitely underperformed for probably pushing the last 5-6 months. Mm-hmm. And what we're seeing, instead of the 7 stocks carrying the market, they're now 40% of the market. Well, now it's the other 493. They're actually starting to show good growth. I think those companies are starting to benefit from AI, actual use of it. So that helps on the profit standpoint. It's definitely skewed the employment numbers a little bit. We're seeing growth in the private sector. It's the government sector where jobs are being cut, being lost in the grand scheme of things.
I'm okay with
that.
Many
people are okay with that. That's, philosophically.
I don't think we need a bigger government.
So that's not necessarily a bad thing. So in general, we have a pretty good environment. There's definitely going to be some speed bumps along the way. We saw, some market volatility just around the announcement of Warsh for Fed chair. Historically, when a new Fed chair comes in, the markets like to test them. Mm-hmm. So he'll be coming into the office, assuming he gets through in May, June. So I think you could get either the bond market or stock market maybe testing him a little bit in summertime. So, that would, be ready for some volatility then.
But I think we both agree that other than valuation concerns with most
Valuation,
tech and AI,
you're going to have some technical things with the new Fed chair, but it's also from an election standpoint, off-cycle election, they just tend to be pretty challenging for the market, tend to be, historically the lowest performance years. So there's some challenges ahead of us that aren't so much fundamental.
There's nothing in the economy that I think triggers like, this is something you got to watch for.
Right. So that kind of leads to where we're at with, on the, from an investment standpoint, we've maintained our equity allocations. We're not in the, probably the most at-risk areas of the equity market. And, as I run through performance, it's starting to show already. I mean, we have decent gold commodity exposure. That's definitely helped. Staying short on bonds. And then, we'll talk about the portfolios. So year to date, of course, year to date, for the month of January, S&P was up 1.37, Dow Jones 1.73, NASDAQ lagged at 0.95. Small cap stocks coming out of the gate pretty strong, up 5.31. The MSCI EAFE, the developed world international markets up 5.19, emerging markets off to a strong start, 8.81%. Aggregate bond index up 0.11. So, we've seen outperformance internationally. Part of that's coming from the fact that the dollar has been weakening. I think the dollar is off about 9% last year. That's not the end of the world. The dollar fluctuates. It is part of that is a result of lower imports. So, there's different pieces moving in different directions that don't necessarily support a strong dollar, but a weak dollar means that's better for our exporters. It does make imports
look cheaper in the international market.
It makes our imports more expensive, but also we have tariffs making them look more expensive. So that's also feeding into inflation. So we got a lot of different moving pieces there. We're not concerned about the dollar. The dollar is not in jeopardy. Our portfolios, dividend yield, really a defensive stock portfolio, up 6% for the month. Gainers include Chevron up 16%, Genuine Car Parts up 13%, J&J up 10%, Darden Restaurants, I think that was up about 9%. Laggards, Old Republic down 9%. So good performance from a pretty defensive portfolio last year. That portfolio definitely lagged last year. And, now we're starting to see movement into those defensive type stocks. Growth with income portfolio up 4.4%. Gainers, Microchip Technologies up 19%, Exxon up 17.5%, Honeywell up 17%, Nucor up 9%, Laggards, Visa down 8%, Apple down 4.6%, Berkshire Hathaway down 4%. Our appreciation with income portfolio up 5%. Big gainers January, Lam Research up 36%, Freeport McMoran up 18.6%, Energy Transfer Partners up 12%, Laggards, Microsoft is taken out of the chin, down 11%, CVS down 8%, Broadcom down 4%. Price potential, which had a great year last year, following it up in January, up 5%. Petro Brazil up 29.5%. Technique FMC up 25%. Vertiv Holdings up 15%. Archrock up 14%. Once again, in the laggards column, Microsoft down 11%, Dell down 9%, Marvell Technologies down 7%. Let's see, the long-term price growth also up 5%. Gainers, Chevron shows up again, up 16%. Rio Tinto up 14%. Newmont Mining up 13%. Plains GP up 9%. Laggards, First Solar down 14%. Netflix down 11%. Apple down 5%. And then our small cap portfolio up 4% for the month. Gainers, Astronics up 40%. Myron Pharmaceuticals up 31%. Bank First up 15%. Park Aerospace, which was bought during the month, up 15%. Laggards, Assembly Bioscience. We walked out of that during the month. It was down 24%. Red Violet down 20%. HCI Group down 17%. Harrow Inc. down 16%. So a lot of action in small caps big ups and big downs.
And that's one of the reasons why we hold that portfolio mostly in qualified accounts.
IRAs,
There's going to be a lot of turnover. There's going to be a lot of gains.
40
It's going to be
position,
volatile.
and our small cap exposure is, I'd call it more higher quality. There's a lot of stuff in the small cap index that doesn't make any money. So the index itself sees a lot of extremes. We've been a little less volatile, or a lot less volatile with what we've been doing. But the big thing is, or the reality is I mentioned before, tech has definitely been challenged, and we've been able to perform despite that. Even though price potential, we have 33%. I'm sorry, 33% tech exposure, but we happen to be in the right tech that isn't so much caught up, so much in the AI.
Mm-hmm.
What we do have, the NVIDIAs of the world, and Microsoft, it's not enough to tank us. But really what's helping is our basic material exposure, our financial exposure, our cyclical exposure, and our communications exposure has really helped drive us through where the broad market's weakening. And I think it's going to be, I don't think it's going to be that hard to beat the market this year. And, that's kind of our objective. Stick with quality. That'll get us through the volatility, that's for sure. We're maintaining our commodity exposure. We've cut back a little bit on gold, going a little more broad-based.
Gold has had a tremendous run.
It's great run. We've had some miners that we've made some good money on, but also spreading out from just gold, broad-based metals, the agriculture, the energy, that helps once again soften the blows, and that provides a bit of a hedge for the kind of environment we're going into. Expectation wise is, like I said, I think it's going to be a decent year. I say that all the time. There's going to be some volatility. I think that's obvious, but once again, we're prepared for it, keeping good, fixed income levels for just, distributions. And I kind of like the setup going into this year. If you have concern about your portfolio, or a big distributions, kind of off cycle type stuff coming in as a household, please let us know so we can adjust accordingly. But I think there's still more room to the upside.
Yeah, I think there's more room to the upside, and we will talk to you again next month. As always, we really appreciate the trust and hope you have a great month. We'll talk to you again in March. Thank you.
Thank you.